Hello, good evening, greetings to all of you. Here I, Kunal Nagpal, welcome you once again to our great economic forum. I hope my dear friends are doing pretty well in their respective lives. Today we are basically going to discuss the two very important modifications done in the overall banking sector and the financial sector. So, dear friends, we are basically going to discuss two very important pieces of information. Firstly, the RBI, that is the Reserve Bank of India, cautions the commercial banks not to outsource their core activities. And the second piece of information which we are going to discuss is the modifications done in the overall financial sector, that is, the rules for the Indian financial sector need to be reviewed to a great extent. So let's begin with today's session. The Reserve Bank of India cautions the commercial banks to not outsource the core activities. Basically, excessive outsourcing of a bank's core activities could lead to the concentration risk with vendors. Reserve Bank of India Executive Director Mr. Ajay Kumar Chaudhary warned recently, underscoring the need for diversification, that is, overall diversification, to maintain the broader financial stability. So while speaking at a technology conference organized by the Indian Banks Association, that is IBA, Mr. Chaudhary added that the bank leaders have to ensure that they don't outsource the core activities. Rather, they should focus on upgrading the core banking operations. In line with our outsourcing guidelines, the broad perspective has to be adopted by the board and the senior management by ensuring that at no point of time the core activities of banks are outsourced, Mr. Chaudhary said. He further added, "We are observing an increase in the outsourcing of services in the banking and finance sector. The idea is that the banks should concentrate on the development and upgradation of their core banking solution." Mr. Chaudhary also said that banks need to diversify while looking at the potential tech partners. He further added, "You need to diversify. I am well aware that with the evolution of technology and the overall upgradation in technological environment in India, it gets demanding for the industry participants to keep the pace. That in turn means constantly you have to collaborate with the tech providers. So this results in concentration. Diversification is perhaps the easiest way to mitigate such risks." The Reserve Bank of India, which has been concerned about the financial institutions outsourcing various core activities such as booking the fixed deposits, sanctioning buy now, pay later loans, and credit card onboarding, is looking to ensure that contracting out of services does not lead to abuse by the non-regulated entities. Mr. Chaudhary also said that the lenders should ensure adequate safeguards are established to preempt instability in the banking system. It is equally important that we all acquaint ourselves with the evolving tech and become self-sufficient in order to reduce the dependency and ensure effective handling of outsourcing. Mr. Chaudhary also advised the banks to maintain the competitive edge by embracing digitization. Digitization, my dear friends, is in fact a blessing for the Indian economy. Digitization is basically happening in silos, he said. It is very important for the banking sector to complete digitization and ensure seamless integration across all the operations and systems. Mr. Chaudhary said that the central bank, that is the Reserve Bank of India, is placing greater emphasis on digitization and is exploring the solutions to provide faster, cheaper, and simpler access to technology. A pilot project for end-to-end digitization of Kisan credit cards, that is KCC, has been conceptualized in association with RBI's Innovation Hub. This will tap into data sources such as digitized state government land records, UIDAI, credit information companies, agri-tech companies, etc. Now, we are basically going to discuss the second piece of information, that is, the rules for the Indian financial sector need to be reviewed. The rules governing the Indian financial sector need to be rewritten to realize the economy's growth potential, said Kotak Mahindra Bank Managing Director Mr. Uday Kotak. The domestic banks are losing out to the global rivals without the leeway to build, scale, and the inability to underwrite the riskier credit due to poor recoveries from bankrupt companies, he said in an interview. India is actually well placed to upstage China on the global platform, with the banking industry as a Cinderella moment that provides the scopes for expanding loans to deleveraged corporates, he said. Indian banks are basically losing big time to the international banks, Mr. Kotak said. As a banker with adequate margin, I would have been very comfortable to lend against the security of Ambuja Cements and ACC shares, he said, referring to Adani's buyout of the companies from Holcim. But in this case, the foreign banks have lent the money. It had to be an offshore transaction because no bidder in India could get money from the Indian banks. The Reserve Bank of India rules restrict the Indian banks from lending to the companies of takeovers. The Indian Central Bank, that is the RBI, always viewed lending against shares as a risky activity because a sudden collapse in the stock prices could leave the banks holding worthless paper. They can lend only up to 20 lakh rupees, a rule that was set after the so-called Harshad Mehta scam of 1992. Mr. Kotak, who was tasked with the recovery of money from the nation's biggest bankruptcy in 2018, the blown up of infrastructure, leasing and financial services, said the insolvency code is fine in principle, but the signs of meager recoveries from the insolvencies of the conglomerates and non-banking finance companies, that is NBFCs, such as Reliance Capital and Stree, call for a review apart from a public interest board for large defaults. He further said, I'm not saying we need to junk the IBC, that is the Insolvency and Bankruptcy Code option. There has to be a policy think on this. This is really required. We have to figure out that for the large national assets, we must think about the public interest route. The objective of the Public Interest Board is to optimize the value for stakeholders, which we have demonstrated in IL and FS. And IBC, that is the Insolvency and Bankruptcy Code, may not be the only route. It needs to be relooked at even for the NBFC, that is the Non-Banking Financial Corporation resolutions. India's investment cycle has to return and the entrepreneurial spirit has to blossom, he said. Initial public offering, that is IPO hype, and excessive valuations in the secondary market can't be taken for granted as gravity can't be defied. India, with its economic foundation, is a strategic play for the global investors. but it could be losing out in the short term as the battered valuations of Chinese stocks make them a short term option. One positive thing is, on a strategic basis, people are concerned about the long term China. On a strategic basis, India should get higher percentage allocations, but on a tactical basis, a trader might say, I would have a quick hit and run in China. Tactically, the traders may take a short term view which could be different. And I think this is a game you need to watch closer every 1 to 3 months before taking a 1 year view at this stage. So, dear friends, this was all about today's session, wherein we have discussed the basic modifications recommended by the renowned economists in the banking sector and the financial sector. I hope you all have been benefited immensely with this great economic session. So on this note, I would like to end today's session, and I hope you all take care of yourselves in the best possible manner. So, Namaskar. Jai Hind.